Personally, I read that book. It was really a mindset change. It talks about kind of the 5 big reasons why to do real estate. Why real estate is very different than the stock market. It's the 5 pillars is what I like to call them. So the first one is cash flow, appreciation, depreciation, paying down the note, and last but not least, leverage.
We didn't know everything that we didn't know, but we had great partners that showed us the great path and the great way to do things. And say instead of a 30-year amortization or a 30-year note on your single family residence, right? You're typically going to have anywhere from, call it 7 to 15 years.
And everybody thinks they're a genius because they know how to go search Google and say real estate versus stock market. And those that are rich sell, those that are wealthy hold.
Hey everybody, Ben Suttles, Feras, Moussa, Disrupt Equity. We're based here in Houston, and we're talking about the long-term benefits of commercial real estate investing. You've been investing for like 10 years, man. Like, so have I, right? And we started off in the single-family world. We got in the commercial real estate world, mainly multifamily. Like, what were some of the things that kind of drew you into it?
To me, so there's a book called The Millionaire Real Estate Investor, right?
I know that one. That's a good one.
That book, I personally read that book. It was really a mindset change, right? Because it talks about kind of the 5 big reasons why to do real estate, right? And once you internalize those and really understand them, it really helps you understand why real estate is very different than the stock market. And so, we'll talk through all 5 of them, right? Really, it's the 5 pillars is what I like to call them. So the first one is cash flow, appreciation, depreciation, paying down the note, and last but not least, leverage, right? Those are the 5 things that make a thing powerful. So leverage, let's start the easiest one. So if I have $1, I can either spend that $1 to buy an investment, or I could borrow another $1. Now I have $2, right? And as long as that other second $1 costs me less than what I can make on the $1, then I'm actually playing the spread, right? So let's internalize it. So let's say I have $1 million to borrow. That $1 million, I borrow it for 5% return.
Yes. Okay.
Right? That loan or that $1 million is going to cost me $50,000 a year, right? I think that's the right math. So as long as I can make more than $50,000, let's say I can take that $1 million and I can go loan it to Ben at 8%. So now Ben is paying me $80,000. I'm paying $50,000, and now I'm making that $30,000 spread, right? So now my dollar, right, dollar for dollar is actually going further. I could have loaned him my initial, if I had, let's say I didn't have the $1 million, let's say I had some money to put towards it, I could have loaned him that directly, but because I can also borrow the $1 million cheaper, I can actually compound my money. So that's what leverage is about, right? It's leveraging your money to get you further, and you're playing the spread. And by playing the spread, you can improve your cash flows.
And so we're talking about lending, right? So lenders are lending people money, right? Let's call it 5%, 6% right now, which is essentially what it is, right? And bottom line, you're able to make a spread there, right? Yep. You get up to a certain amount of leverage on a property. So again, using the law of large numbers, let's say it's a $10 million property, right? Right now you could get 70% leverage, right? So what that means is you get a $7 million loan on that $10 million property, and maybe at 5% interest rate, right?
And you need to bring that $3 million.
You have to bring that $3 million in equity. The other thing that I love about commercial real estate, though, and syndication is kind of the space that we're in, is leveraging other people's time, other people's equity, other people's experience too. So leverage can be a lot of different things, and it's synonymous across the space with all of these different creative things that you can do to make more money. Leverage, I love the idea of leveraging other people's experience, right? When we started off, obviously, we didn't know everything that we didn't know, but we had great partners that showed us the great path and the great way to do things, and allowed us to avoid some of these landmines.
Immediate deal partners to lenders to counsel, legal to
the whole team.
Insurance, the whole thing. So there's a lot of parts to that.
Yeah. So leverage is probably I would say one of the most important things, right?
Absolutely. So that's a good segue to the next one, right? Paying down the note. So whenever you have a loan in place, over time, that note gets paid. For those of you out there that have a house, right? You probably have a house at a 30-year mortgage.
Principal and interest.
So if you just hold that house for 30 years, paying that monthly, guess what? You own that house free and clear at the end of it. Commercial real estate's no different. As long as you're not on an interest-only loan, right? You are paying down the note over time. And so if you can continue to service that note, right, at the end, you walk away with that deal free. And so you are basically burning down on the amortization schedule, right? You are slowly paying down principal, and that's a very powerful thing. And I think people get fixated on cash flow and on everything else, but over time, right, that's powerful. That's why, what do we like to say real estate is, Ben? Is it a short-term or long-term investment?
It's a long-term play, right? I mean, and you can build a lot of wealth over the long term, right? It's not a sprint, it's a marathon, right?
Yeah.
And the one thing I was going to say though, just to make note, right? Because we brought up single family or people's personal residence as an example, right? A little bit different loans in the commercial real estate space. So say instead of a 30-year amortization or a 30-year note on your single family residence, right? You're typically going to have anywhere from, call it 7 to 15 years on a commercial real estate loan. You know, and it's not meant to necessarily pay the whole thing off. You can, there's loans that will allow you to do that, but most of the time you're just paying it down. So over time, you're gonna burn off some of that interest and you're gonna pay more towards principal, and that's what an amortization table is all about, right?
Absolutely.
So paying down the note, number 2. Number 3.
All right, let's talk about these two together, right? 3 and 4. Appreciation and depreciation. Ooh. They're kind of synonymous, but they're actually complete opposite things, right? So again, appreciation, we all understand appreciation, right? Over time, right, with inflation, the cost of things goes up. Yep. And whether that's you're buying an Apple or you're buying a $20 million piece of real estate. As inflation happens, as people make more money, as taxes go up, as insurance go up, everything, well, guess what? Costs go up and you end up actually basically collecting more cash. And if you keep the cap rate stabilized, well, your value does go up too, right? And so ultimately, appreciation, right? It is what it is. Over time, right? We're talking about the long term. We're not talking about the 1 to 2 year. I can't look at a crystal ball and tell you if next year is going to be more expensive than this year, right? But over long, and again, the government says it themselves, they try to peg inflation at that 2.5–3% rate, right? So the government is incentivized to try to keep it. And so over time, you're getting appreciation in real estate, right? So it's over the long term, 20-year cycle, you're getting appreciation. And again, if you hold on to real estate long enough, you start to get that benefit. And I mean, I have a perfect example. I was looking, I'll tell you a true story. One of my last remaining rentals, me and a friend bought 8 years ago, probably, which finally we're putting it on the market to get rid of that thing. And I literally looked up the closing statement that we bought it at 8 years ago. And I'm like, man, I didn't realize how cheap we bought that thing for, right? We bought it for $200,000. Now that thing is probably worth $400,000, right? That's appreciation. We didn't do anything magical to make the deal much better. That's just the market and it appreciating over time.
All right, so different parts of appreciation, right? So this is what I love about single family versus commercial, right? You know, in single family, it's all about market appreciation, what you can get on your comps, what the subdivision is selling for, which is still somewhat relevant in commercial as well. But the other thing that we love about commercial real estate is there's forced appreciation. So what does that mean? Right?
Yeah.
So talk to us about forced appreciation.
So to keep it simple, right, the way commercial real estate is valued, it's based on how much income a property makes. So if you can increase the income, well, guess what? Your value goes up too. And so the most simplest example I think everybody understands, if I install covered parking spots and I rent those covered parking spots out at $30 a piece, regardless of how much it costs me to install the covered parking, because that's a CapEx item, but if I'm making $30 a spot more a month than I did before, and that really goes straight to bottom line, right? There's not really much management or operational costs in having covered parking. Well, now I've grown my income on that property. And again, if you're buying the property at a 5 cap, 5%, you basically get to take that 30 divided by 0.05. And typically you're basically making 15, 20x return on that. And so in terms of what the value is. And so forced appreciation is doing things to drive the income up. So therefore the valuation of the asset goes up. Now, whether you want to sell the asset or you're going to go refi and pull money out of the deal, right? All of those things go into factoring what that asset is valued.
Yeah, so forced appreciation is a huge factor and is really the more specific to the commercial real estate space. So that's one of the reasons why we always tell people as a passive or an active investor, doesn't really matter. If you're in the commercial real estate space, understanding how forced appreciation works. You know, another example of that is, you know, you come in, you do your unit upgrades, right? Yep. You say, hey, I'm going to increase rents by $100 and you've got 100 units. Well, that's another $10,000 a month times 12. That's $120,000 more in income. You divide that by a cap rate, and let's call it a 5 cap, right? You're adding significant value.
So how much value did we add, Ben?
I don't know. The
answer is $2 million.
Right.
Oh, actually, I got it. Yeah, 2.4.
It's close.
2.4
right?
is the answer.
So, but bottom line, that's a lot of money, folks. So you just created $2.4 million in value on that property just by increasing rents by $100, right? So that's appreciation. Now, the flip side of that coin, depreciation.
Depreciation. So again,
which is kind of like, this is like
they sound like polar opposite, but they're actually a beautiful match made in heaven.
And I would say it's one of the misconceived or just misunderstood things. And I'd say that one of the things that people don't understand, even getting into commercial real estate, they hear about appreciation, they hear about cash flow.
And they have a little bit of depreciation on their house, right? Because their house can be depreciated over 27 and a half years.
So
right?
let's get into this. Let's dive into it.
But essentially, to keep it really simple, right? It's a way to generate negative income on a property, right? So that way you can take
paper losses.
Paper losses. You're getting that paper loss, and if you're an investor that has the ability to, you're able to basically take that, put it against maybe income you've produced elsewhere and save on your taxes, right? We all, regardless of what you think of Trump, we all heard the news, right? Hadn't paid much taxes in whatever, 10, 15 years.
Yeah.
Well, it's because he's in real estate. Real estate gives you a ton of depreciation. And so different than a house, right? A house you get to depreciate over 27 and a half years, which you can do in commercial real estate, but commercial is actually more impressive because there are tax things that allow you to do what we call cost segregation and accelerated depreciation. And we're not going to go into those here, but all it does is it lets you front load a lot of those losses. Instead of dividing it over 27 and a half years, you can get a lot of it year 1, year 2, year 3, year 4. And again, right, it's a way to juice losses. So if you made a lot of money one year, we have investors that say, hey, I only want to invest in a deal that has a lot of depreciation because they made a lot of money. They have the ability to basically offset that money with losses and pay no taxes or reduce their tax burden.
Yeah, so check with your CPA. There's a lot of nuances to it, right? But essentially, the way that you can kind of look at it is you can have massive paper losses and still made tons of distributions and made tons of active income on that property or passive income on that property that year, right? And those things would potentially offset each other. Value creator and wealth creator that people just aren't really in tune with when they get into commercial real estate. And then once they understand the power of it, a bunch of high income earners, we have a lot of doctors, a lot of lawyers that invest with us because those folks are making a lot of money each year, right? And so they need to offset all of the taxes they're paying Uncle Sam. And it's a great way to do it. Last but not least,
cash flow.
Cash flow.
So this is the one everybody thinks about whenever they talk about real estate, right? And everybody thinks they're a genius because they know how to go search Google and say real estate versus stock market. And what do you see? You see that the stock market has averaged 10% a year. And then you'll see one of two numbers on the real estate side. Either it'll talk about what cash flows look like or appreciation. And a lot of times it's actually appreciation. It says real estate appreciates 2% a year. 2% is less than 10%. Therefore, real estate sucks and stock market is better, right? But again, it's these 5 pillars, they all compound together. So the other one that you typically see is about cash flow, right? Producing hard cash month over month in your deals. And that's where we talked about leverage at the very beginning, right? The more leverage you have, the more debt service you need to pay down, and typically the less cash flow you have. So those are kind of, it's a balancing act. And so typically that's why we like to go lower leverage, right? Going in 65% instead of 80% makes life easier. You get to sleep better because you have a lot more cash flow. And cash flow is basically cash left over in the deal after paying everything from insurance to taxes to payroll to utilities, right? Money there that's there to distribute. And that's ultimately what we look for with real estate, right? People invest in real estate just for appreciation and depreciation. There are people that don't care if there's any cash flow.
We've literally had people say that. They're like,
some of the family offices and those people are in it for the 30-year haul, right? They're not making an investment for the next 5 years, right? And again, there's not a right or wrong. It's about what your thesis is. And for us, we like cash flow, right? Getting positive cash out of a deal to be able to distribute to investors, just like whether it's, a piece of real estate or a business, right? Most business owners, why do they have the business?
Profitable.
They have those businesses to produce cash and that they're taking home and spending, right? And so that's ultimately the cash flow side.
So let's talk about like what is, right now in the cycle that we're in, right? 6 to 8% is kind of what we're seeing.
Yeah.
So to give you guys some perspective, right? You put $100,000 in, let's say you're getting 8% cash on cash per year. That means that you're getting $8,000 back as cash flow distributions on that investment each year, year in, year out. When you're seeing that, when you're seeing a prospectus or a PPM or investor deck and people are talking about cash on cash returns, that's how you calculate it, right? So it's the most kind of, I'd say, straightforward metric.
Yeah. It's ultimately how much hits your pocket each year.
I mean, like how much money
which is different than IRR, right? IRR, just to kind of give a shout out, IRR stands, basically it's internal rate of return. And what it's about is over the life of the deal, right? Yep. How much cash was produced, not just cash, but ultimately what was the return, the yield on your money from what went in to how much did it appreciate to how much did you exit to what did cash flow all in. That's what IRR is. And again, the problem we have with IRR is that it's really tied to a hypothetical exit at some point in the future. We don't know what the market looks like in 5 years. And so cash flow is a little bit more meaningful because it's a little bit more in the immediacy, right? You can look out a year and understand, hey, this should be able to produce this much cash flow.
Yeah. And one thing that I want to kind of mention too, just it's somewhat in line with the cash flow, is also kind of total return, right? So you have your cash flows that you're making throughout the hold period or the time that you own the asset, right? And then you're going to have an exit, like we said, right? So down the line, hopefully you paid down the note, you've had some appreciation, right? You've made the deal more profitable through forced appreciation. And now you have this exit, right? And you've made, whatever, millions of dollars on proceeds, right? You're going to blend whatever proceeds, amount you've made there, plus the cash flow, and that's going to become total return, right? And then average annualized return is just taking the culmination of those two things and dividing them by the amount of years that you have them.
Divided by time.
Divided by time, right? In the investment. So those are some of the great things, right? But how do you get into something, man? Like what is like, I mean, we're talking about all the benefits, you know, I mean, what does a passive investor have to do if they want to get into
I'd
something
say it's about going out there, buying some real estate, right? Whether you're looking to be an active investor and go buy a house down the street, buy a shopping center in the area, or go find an operator to invest in that does the heavy lifting, right? That's ultimately what passive investing is about. It's about deploying your money with a group that's going out there and dealing with all of these things. So,
right, you know, and I think this is a great time in the market, right? You know, we're
seeing some really good cost, plays right now.
Great
the basis is great out there.
And I think people need to realize that this is the time to be getting yourself educated and getting into the game and taking some action.
So there you have it, folks. That's the 5 pillars for long-term strategies for real estate. So again, there's a phrase that I want to finish up with that I heard about, and it might have been about a year and a half ago, and I really, really love the phrase, which is ultimately those that are rich sell, those that are wealthy hold.
If you like this content, folks, please drop us a comment, drop us a like, share the link, and follow the page, Disrupt Equity, and we'll see you on the next one.
And let us know what you'd like us to talk about next.